Happy Tuesday, everyone. Welcome to another edition of Rate Desk. I am your host, Michael Thomas, here to talk about the multifamily markets. But first, let's start with the broad markets. I was watching the news programs today, and some analysts are talking about a V-shaped recovery. It's kind of interesting. That would mean we're already kind of on our way into a bull market. Is it really going to be a V-shaped recovery? Other people are doubtful. It kind of reminds me of that show in the 80s, Visitor, V for Visitor, where they look like regular people, but then underneath they're these lizard aliens. So some analysts are predicting that you peel back the veneer of some of the good news we've had lately, we still are in a bear market. I guess time will tell. We are seeing movement of dollars towards the stock market, causing the yields on the 10-year to go up. That means the prices are going down because they move inversely to each other. So we have seen 8 basis points pick up in the US Treasuries. Today they opened at 77. Now they're trading around 72 basis points. Again, that's about 8 basis points over yesterday. Let's jump into the FHA rates. The 223F permanent rates tightened just a little bit. So we've got a 2.57, that is 257 on a 35-year fixed fully amortizing loan. And the 221D for new construction sub-rehab unchanged from yesterday at 3.30. Jumping over to the agency desk and our friends there, they have tightened about 6 basis points. We're seeing a Fannie 10-year trade today at about a 3.36, and a Freddie Mac 10-year at 3.44. That's 3.44. So I did receive confirmation on the debt service reserve requirements. Freddie Mac is going to require fully amortizing debt service requirements for 6 to 9 months, regardless of due diligence. They don't care about anything else on the deal. You're going to have 6 to 9 months sitting in a debt service reserve. Now, in certain cases for Freddie, you're going to have 12 months. And in the case of specialty properties like student housing, as an example, you've got 18 months. Wow, that's a long time. So you'll have a debt service reserve, principal and interest payments for 18 months in the case of student housing. Jumping over to Fannie Mae, on a typical tier 2 property, that's 75 to 80% loan to value, 1.25 debt service coverage ratio, 12 months of principal and interest payments. Okay, warning guys, overall cash out is going to be limited in this market. The agencies are not feeling real bullish about borrowers taking chips off the table. So 12 months required debt service reserve, limited on cash out, otherwise still open for business, for refis, for acquisitions. You're likely going to see better pricing on lower leverage properties. Again, just kind of due to the market that we're in currently. And lastly, there was an interesting point I wanted to make. I read an article today that was saying one way to manage the risk that the investors see in the marketplace for multifamily is to take a look at the spread between the 10-year yield and a cap rate. I thought that was pretty interesting, so I thought I'd throw this up there. An average cap rate of 5.75 in a secondary market in today's UST at 72 basis points gives us a risk premium spread of 503. That would be the premium an investor is demanding in order to take the risk of investing in multifamily over a so-called risk-free US government bond. I thought that was very interesting. I'd like to keep an eye on that, and I'll report more on that in future episodes. Let's see how that changes over time with this news and these moves in the market. It's a good time to borrow. It's a good time to lock interest rates. Again, thank you for tuning in. If you like this episode, again, please click, subscribe, come back and see us again. This is Michael Thomas with Rate Desk.